welcome to Xinjiang Wall Street Moment. Today our guest speaker is Peter Acosta, and he's the president at the Empire Executions and the governor at NYC. It's great to have you with us, Peter.
I'm glad to be here.
Well, first we'd like to talk about the commodity market for the gold price. The gold market is moving lower in recent sessions, but many are still thinking about we have the chance to move into the $1,400. Do you think how much possibility we're going to reach that range?
Well, I think that what we've seen over the last month and a half or 2 months with gold is that it's reacting to two things: what's going on in North Korea, which is still an ongoing situation, and also about the fact that the dollar has dropped precipitously. Dollar rallies a little bit, gold came back in. So what I do think is we probably will see $1,400. I don't know if we're going to have a sustained period above that level, but I definitely think that it's the potential for rallying to 1,400 is there. I don't think it's going to take a whole lot. And then we're looking, as the dollar if the dollar does pick up strength again, which is very possible, then maybe it might just touch there and stay in the 1350 range.
How soon do you think it's going to reach that?
Well, it's
level?
tough to say. I think that, we're going to get through September, probably in this, I would say before the end of the month you'll see it. I think there's still, some economic touch points or data sets that might affect the gold a little bit. Probably during this month you'll see it. I'm not sure if we're going to end the year there, but I would think that this month we'll see that level.
And with the considerations of the hurricanes damage and the rebuild and the latest inflation data, do you think that will help the case following up for the Fed balance sheet normalization with the next rate hike in December?
When you look at the rate hike in December, the thinking was it's a 50-50 shot based on data going in. This is obviously something that the Fed has been waiting for. They want, some sort of inflationary movement. This, maybe it's a one-off. Maybe this is the only, maybe next month we'll see it pull back a little bit. If you see it in October's readings and you see the CPI come out in this level again, you'd be pretty sure that the Fed is going to do something in December. I don't think they should, but looking at inflation starting to pick up, and then we have to wait for the jobs numbers to come out. I believe it's next week. I'm not sure. Yeah, I think it's next week. The jobs numbers come out, and if you see wage inflation, the Fed is definitely it'll perk up their ears. They will be, ready to do something, and I think the chances of a Fed rate hike in December will be significantly increased. I think that the Fed they're waiting for wage inflation, because whenever you see a pickup in wage inflation with, it's been elastic. The wage band has been very elastic. You've seen employment or unemployment go to levels that we haven't seen in 20 years, and you would think that would cause the labor market to tighten up, but it really hasn't. So, we start seeing some wage inflation. I think the Fed will definitely be proactive, not preemptive,
yeah,
proactive in December and raise rates.
You're wait to see. Let's switch to the crude market. Well, WTI today just topped $50 per barrel for the first time in 5 weeks, and one of the reasons the global demand estimates are rising. So how much do you think that will support the WTI stay above $50?
I think the important thing with the WTI and Brent crude, I think the important thing is that the Russians and the Saudis feel that they're finally seeing some sort of price improvement, and I think that they, rightly or wrongly, believe that their cutting back in production is the reason that we're starting to see this consistently above $50 level. I don't think that's the case. I think it's more about demand. I think Europe's demand is going up, the U.S. demand is going up. China's, even though there's some weak data in China, their demand is starting to go up again. So I think it's more about demand. I don't think it's so much about the lack of supply. But that being said, I think they're meeting again in November. I'm not 100% sure, but I think they're meeting again in November to verify numbers and maybe even cut back more. So I think that you're going to probably see this $50 level. That might end up being a base. So right now, for 6 or 7 months, it's been a top. Now it might be the base of where the oil prices are. We have to wait and see though.
This morning, the Wells Fargo is just warning investors that record market gains could soon slipping away. So what's the prediction of the following performance of equities by the end of the year?
Well, you know what, the market's at a level right now. If you look at the U.S. equity market, it's record highs all the way across the board. It's making these highs, and they're very incrementally small. That's typical of a tired market. I mean, there's still money flows into the market, which is good, but they're having a hard time finding a place to go. So what ends up happening is, there's not a value play there, and money just flows in, and I think that's going to consistently happen. But the reality is, if we don't see tax reform, this market could turn around very quickly. Although I do think it's going to happen, I do think we're going to have tax reform. Don't think we're going to see it in 2017.
The market knows very clear that we can now get the tax reform by the end of the year, right?
Right. Yeah, I think that that's already assumed. I think we'll probably see in the first quarter of 2018. That would definitely help propel the market, because now you have corporations' earnings will be impacted significantly to the upside, and we'll see about that. But the market is tired. I mean, Wells Fargo may be a little bit more bearish than I am. There's still a lot of money out there. There's still money flowing in based on, you see ETF flows, and but it's all very, very small. I mean, the incremental rises are very, very small. So, the market could turn very quickly, but every time it does, it finds a base not too far down, and then it rallies back up from there. So we're not a bad place that, we have to look at. We're looking at the debt ceiling. That could be an issue. That doesn't seem to be as much of a problem now. I mean, there's a lot of things that were negatives against the market are being taken out. The positives haven't been implemented yet. So, when you have a market at record levels and the positives haven't been put into it yet, there's a possibility that we can see a lot more movement on the upside. But like I said, I think it's going to be later into 2018, not 2017.
Yeah, we will see that.
Yeah, I mean, we're in a good spot right now, and I think a lot of investors are either not going to do anything because they're locking in gains, and they have these gains. And
so far so good.
Yeah, there's very few places to put your money. If you're going to enter the market now, there's not really that many places to go. So. It's going to be a tough go. I don't see anything unless there's some sort of geopolitical crisis, be it North Korea or something else. I don't see anything that's out there that really looks like it could be a detriment to the economy or the market. So, if you're in it, stay in it. If you're not in it, I don't know what to tell you. I mean, I'd like to be able to say something, but I really don't know.
We will save that for the next show,
yes,
next
absolutely,
interview.
Absolutely. Hopefully the market's down a few thousand points, and I'll say now's the time to buy.
Yeah, and thank you so much for joining us today, Peter.
Oh, it was my pleasure.
Thank you.
Thank you.
Thank you for watching Wall Street Moment for this week. See you next week.